If you're a business owner interested in keeping more of your profits and paying less taxes, stay tuned. I specialize in helping business owners with good to great cash flow save a lot of money quickly. It's all about efficiency of capital, making sure that your dollar's working for you, not Uncle Sam. My name is Dana Bake with Cetera Wealth Partners. Let's begin the presentation.
Pension Protection Act of 2006 clarified how combining a 401k profit sharing plan with a cash balance plan can optimize retirement savings for business owners. Through optimal plan design, we can significantly reduce taxes, accelerate retirement savings, protect assets, and retain key employees. The issue is most small business owners are unaware of these powerful tools. Many advisors are also unaware of this powerful planning. Let's compare basic planning with advanced planning. Basic planning is suitable for new businesses without significant tax issues. They traditionally utilize 401ks and profit sharing plans. Advanced planning is ideal for high income businesses with stable to great cash flow facing substantial tax bills. Advanced planning provides for larger deductions and accelerated savings. Most folks are familiar with basic planning with 401ks and profit sharing plans. Returns depend on investment performance. Contributions are based on W-2 income. Maximum annual deferrals are low based on any age. But with advanced planning, adding a defined benefit plan to your current retirement plan can offer higher contributions for older, higher paid participants. We can combine those contributions with your existing 401k and profit sharing plan. And the plan design can be owner-centric. We can achieve substantial retirement savings for the business owner. Future Plan is an actuary that has a great illustration of the power of adding a cash balance plan to your existing retirement plan. We're going to focus on the chart on the left-hand side of the page. This chart illustrates by age the maximum contributions in 2024 if you have a 401k only as a retirement plan solution. By adding a profit sharing component to a 401k, we get a little bit higher contribution. Notice adding the cash balance plan offers a significant contribution in addition to the profit sharing in 401k. Imagine the power of a 66 to 70-year-old business owner achieving a contribution of $452,500 per year. If you're in a combined 45% federal and state income tax bracket, that could equate to a $203,600 tax savings. In addition, 401h contributions are allowed in defined benefit plans. The purpose of 401h contributions are to fund medical expenses for retirees, their spouses, and their dependents. The tax benefits are substantial. Contributions are tax deductible, earnings grow tax-free, and distributions are tax-free for qualified medical expenses. These type of contributions are limited to 25% of the retirement plan contributions to the defined benefit plan, and they have to be maintained in a separate account within the pension trust. 401h contributions can be used to pay for medical expenses not covered by Medicare or other insurance plans, such as copays, out-of-pocket expenses, and even long-term care costs. Not all plan actuaries offer 401h plan design. Let's review the tax savings. Summarize the tax savings. Plan contributions are fully tax deductible to the business owner. Plans can be funded by the tax filing deadline, including extensions of the sponsoring entity. Of course, we have to allow ample time for the actuary to do their work, and you also have to have enough time to submit your taxes to the IRS. There's a potential for double tax savings and deductions in the setup year of the plan. We can potentially fund prior year and current year contributions in the first year. The lump sum limit annually for cash balance plans is $3.5 million per person at age 62 for the tax year 2024. Cash balance plans can be flexible. In a lean year, contributions can be adjusted. The plan can be amended, frozen, or terminated by mid-year by working with the actuary. In a lean year, contributions can be tied to W-2 pay. Plans can be funded maintain an over or underfunded plan state for a certain period of time. When a participant retires or leaves the company, they have the option to receive their accrued benefit in a lump sum payout. Note that not all partners and business owners are required to participate in the plan. Usually we see older, higher paid owners participating in the plan. Cetera Wealth Partners offers 321 and 338 investment fiduciary services. 321 fiduciary services involve financial advisors offering investment advice to plan sponsors. 338 fiduciary services allow investment managers to take full responsibility for investment decisions. This helps with ERISA compliance. Plan sponsors can delegate selecting, monitoring, and replacing investments to a 338 plan fiduciary. Who are the top candidates for these types of plans? Medical groups and law firms, professional, scientific, and technical service entities, financial and insurance businesses, wholesale and retail trade, manufacturing, real estate rental and leasing, just to name a few. Any small business owner with $350,000 or more in annual profits that are looking to accelerate retirement savings and reduce their taxes. Any business entity is a great candidate with a 1 to 10 owner to employee ratio or less, with stable or great cash flow. It doesn't matter if you're a partnership, an LLC, a C Corp, an S Corp, a sole prop. All of these entities can incorporate defined benefit plans into their existing retirement plan. We offer a complimentary feasibility study to see if it's viable to add a cash balance plan to your current retirement plan. All we need is a current employee census for a free feasibility study. We'll show you how much the plan would cost and how much you could save in taxes. We can design the plan to be an owner-centric plan and still be fully compliant with ERISA.
When I speak to business owners for the first time and they learn about this type of advanced planning, their first reaction is often silence, followed by inquiries about finding knowledgeable accountants and advisors who are familiar with these types of strategies. If your advisor has not recommended these strategies, it's an awful big miss. Think about the tax savings and investment growth foregone over the last decade without this type of advanced planning. It's all about saving money quickly and efficiency of capital, making sure every dollar works for you and not Uncle Sam. Today we discussed advanced planning strategies such as large tax deductions, tax mitigation, accelerated retirement savings, and asset protection. All of these objectives can be achieved. Has your planning kept pace with your business success? If you would like to learn more and discuss how these advanced planning strategies may or may not benefit you, please click on the link below to schedule a strategy session.